Good morning. Slow day today in terms of data. What we really were looking at in terms of interest rates already dropped at 8:15. We'll talk about that more. But at 9, we do have home prices. Certainly interesting for those of us in the mortgage business. Maybe we care about consumer confidence at 10. Not really sure. Obviously, everyone's sort of holding their breath until tomorrow, although, unless the Fed does something crazy, and make no mistake, there are folks, that think that they might hike. The consensus at the moment, at least, is a hold. And, how I look at, well, before I talk about that, we'll give a couple folks an opportunity to join. So let me just talk about the overnight real quick. And I think that the real news, so to speak, is NVIDIA, I think, dropped like 5% or something along those lines. And so there continues to be some consternation around, chips, AI. Once again, I'm kind of flummoxed by that. But, nonetheless, I mean, Korean markets were down 11%, Nikkei down almost 4%, a little more mixed, if not slightly up in Europe. And generally speaking, we're indicating up here on shore, except, of course, NASDAQ being dragged down a little bit by this, kind of whatever you want to call it, chip AI sentiment right now. And NASDAQ indicating down almost a point, VIX up a little bit, commodities down across the board, most notably, and for those of you that want lower interest rates, thankfully, oil. Crude down a point, Brent down 1.5 points, and we're testing a 70 handle on crude, 81.50. So, we're getting back in the vicinity of 70s a barrel for crude, whereas we were, not very long ago, bracing for potentially $100 a barrel. Boy, I tell you something, if you've been on the right side of the oil trade, God bless you. 100 down to 60, back up to 100. You did pretty well. Dollar generally stronger versus pretty much all currency. So now that I've stalled somewhat sufficiently, for us here on shore, big news of the day, if you want to call it big, a weekly ADP printed at 15,000, down from 16.5 last week, which was already a low number. You talk about a 2-week at 31, that would project out to a 4-week of about 60, low 60s, 62. And so I think things are about to get really interesting. In this next week and a half, you've got Fed decision, you have Q1, first look at Q1 GDP, you've got PCE, you've got ADP, you got non-farm, and then I don't know if we get through both ISMs. But we do. We get through both ISMs next week. I know that we've been trading jolts. I don't know what they matter once non-farm prints, but nonetheless, you've got jolts next week. And if you trust this ADP number, next week's job numbers are going to be really, really interesting, right? And I think what's going to be really more difficult to predict as you get into the following week, and I think we already covered this ground. I'm pretty sure we don't see CPI the following week. Maybe we do. Just how much of an impact does the price of oil have on July inflation? Because, let me look at a crude oil chart. We got up into nosebleed territory, but really for how long? If I pull a 1-month chart, right, July started at 68 a barrel, okay? Through July 7th, we were at 68 a barrel. We popped up above 70, but then again, we were in the high 60s, mid to high 60s, low 70s, really as late as July 13th, July 14th. All right. It gapped up to, 70 something July 16th. We really didn't achieve, an 80 handle until when? maybe July 20th ish. And mid 80s, high 80s was for a couple of days. So, I have to say, I think that the jury is out on the impact of oil prices on July inflation. Now, we certainly know the prices at the pump and so forth go up faster than they go down. But I'm not convinced that July's inflation readings are going to be ruined by oil prices. Now, we've got 2.5, 3 days left. I think that has something to say about it. I think if we kind of revisit 70s here, I listen, and one wonders how the Fed is going to digest this. I would venture to guess that tomorrow, they arguably are going to talk about a softening labor market. I think that would be appropriate, right? That's what we've seen. And I think that what they should be talking about in the rearview mirror is softening inflation. That would be appropriate. I think that them talking about the correlation to oil and inflation, I could argue till I'm blue in the face about that's not appropriate, but that would be appropriate, right? Listen, you could figure out 100 reasons why they would want to hike rates, just if for nothing else. They have been in somewhat of a hawkish posture. But if you look at the data, and now all of a sudden there's renewed optimism in Iran. I think it's now 3 straight days of no strikes, and the president came out at some point yesterday or last night, saying that he was very encouraged. Admittedly, what was for the millionth time in the last 5 months, but to me, for the Fed to trade higher oil prices and potentially higher inflation, at least with what we know right this second, is yesterday's news. Long story short, I think that it's reasonable to surmise a continued Fed pause, 1. 2, I think it's reasonable to surmise that there might be some headline hawkishness, but maybe they back off it a little bit. I don't know how that works with this movement towards lesser forward guidance, right? To me, if I'm the Fed chair, I get up there and I say, listen, we see a duplicity in the markets. We see a softening in labor. We see a balanced risk to inflation driven by Iran. June was a very friendly month. July started off friendly. We had a hiccup, but we think we could be back on track. So we're pausing here, and we're going to continue to be data dependent. And then next week, when the data is terrible, and I think that, how I like to quantify things sometimes is I think there's a 70-75% chance that the data is terrible. You can excuse away a potentially hot CPI number. Now, obviously, this week we're going to get PCE, and it used to be that was all that mattered. What's going to be really interesting about that PCE number, and we've talked about this, how CPI doesn't consider substitution, meaning, well, there's 1,000,000% inflation in beef, and everybody just stops eating beef, and there's been deflation in chicken. So therefore, and everybody's eating chicken. So what really matters? That you're paying less for all the chicken in the world or more for no beef? PCE considers that much more thoughtfully than CPI, which really doesn't consider that at all, right? So this could be a very interesting PCE number. This PCE number, could, and particularly because it's June, right, could really print a very bond-friendly number. Why do I say that? Because I think anecdotally we're seeing some weakness in labor and the consumer. So if we have an extraordinarily weak PCE, boy, does that really take the edge off of oil prices? I don't know. We'll see. That's how I see it. So Net, what does that mean for us? How do we trade it if you're in your float lock considerations? 463 or 462 and change on 10s. 6 coupon is essentially back to almost auto lock, 6 1/4 and above, or 6 1/4 to 3/4. I'm not saying that you're at the absolute best levels, but we're pretty much auto lock for the next week or two. I mean, you have no opportunity to react to a hawkish Fed tomorrow. So I just don't know why you would float into that. We're a little short 6s this morning, and we're going to get a little bit shorter. 5 1/2 coupon, still haven't seen the bounce there. We continue to be maybe about 25 basis points off the worst levels. 5 coupon, we've seen a bit more of a bounce there. We're about 1/2 point better than worst levels. So if for some reason you're still selling 5 1/4 to 5 3/4, I think this is a reasonable lock opportunity for you. If you just took on a recent floater, you're probably offering them today a rate that's maybe 1/8, possibly 1/4 better. I don't think so, but if it were, I think you have a good story to tell. Why would you not lock it? And if you got caught offside, listen, you have the opportunity to save some face. So, I think that you're somewhere between 40-60 to 80-20 lock on 5 coupon, just because I just think there's too much risk there, although the level stinks, right? I think 5 1/2 coupon, I need to see a little bit more resilience, but I think that's 50-50 proposition, and 6 1/4 and above, I just buyer beware. You could make the argument, right, that this data continues to worsen, so you're gonna take a risk, but just know what you have in front of you. And I think more than anything, it's the Fed. I think that the direction of oil, vis-a-vis the direction of this renewed optimism about a truce, the direction of the data is almost 100% float, right? So I want to be clear and not mince words about this. When I look at a chart, other than say six coupon, it says float to me. When I look at a calendar, it says float. When I look at the data and the trajectory of the data, it says float. But you're in a business, you're in an industry where the bias should always be lock. And you're at a moment in time with the Fed and then some July inflation data coming up, where there's risk because of the price of oil or because of what's happening in Iran. So right now, and this kind of happens around this time of year every year, I think I said this last year, this is a more difficult market to trade than, say, it was 2 weeks ago, 3 months ago, so on and so forth. So buyer beware on that. Why? Because bulls and bears make money, pigs get slaughtered. Thanks for joining live, watching on replay. I'll see you guys tomorrow.